Welcome to today's deep dive, everyone. We have a really, just a critical mission today, honestly. We are unpacking a topic that is vastly misunderstood by high net worth investors.
Yeah, vastly misunderstood is right. It's a huge blind spot.
It really is. So we're diving into the true costs of wealth management. And to do this, we're looking at a comprehensive guide from the 1715 Treasure Coast Financial Wellness podcast.
Right, which is produced by Davies Wealth Management.
Exactly. They're a fee-based fiduciary advisory firm out of Stuart, Florida. And their core premise throughout all of this is that most people, they just evaluate financial advice fees completely incorrectly.
They really do. I mean, they look at a static percentage on a statement instead of calculating the total dollar impact, compounded over decades.
Right. Well, so to set the stage for you, the listener, picture this. You're rowing a little wooden boat right off the shore of a calm lake, and you notice a tiny leak.
Just a little one.
Yeah, a few drops of water seeping in every minute. No big deal, right? You just bail it out with a plastic cup and you keep on rowing.
Right, because it's manageable. I mean, you're close to land. The stakes are super low.
But now imagine you're crossing the Atlantic Ocean in a massive multi-million-dollar luxury yacht.
Okay, totally different scenario.
Right, and you have that exact same type of leak, just scaled proportionately to the size of this huge vessel. Suddenly, that slow leak is taking on gallons of water a minute.
Oh, wow. Yeah.
Over a multi-week voyage across the ocean, that continuous, unrelenting leak could just entirely sink your ship.
It is the absolute definition of compounding destruction. I mean, it really is.
And that explains why high net worth individuals have to view fees fundamentally differently than, mass market investors.
Absolutely. Because our brains are wired to think linearly, right? Not exponentially. So when we see a fee of, say, 1%, we think, oh, 1 penny out of every dollar. That's nothing.
Right. It sounds tiny.
It does. We don't see the water accumulating in the hull of the yacht over a 20-year voyage.
But wait, I have to play devil's advocate here. Isn't 1% just 1%? I mean, why do investors get so blindsided by the math when their wealth scales up if the percentage stays exactly the same?
Well, it's because of a concept called reverse compounding.
Okay, reverse compounding. What is that?
So most people view a fee like a utility bill, right? You pay it, it's gone, you move on with your life. But an investment fee is paid out of the portfolio itself.
Oh, I see.
Yeah. Every dollar you pay in fees today is a dollar that gets removed from your compounding engine.
So it's not just the money you paid this year.
Exactly. It's the growth that specific money would have generated over the next 20 or 30 years.
You're losing the capital, and you're simultaneously losing decades of future growth on that capital.
Precisely. Let's look at the contrast in scale just to make it real. For someone with a $150,000 portfolio, a 1% advisory fee costs $1,500 a year.
Right, which is noticeable but not life-altering. Right. But apply that exact same 1% fee to a $3 million portfolio, and you're paying $30,000 annually.
Wow, 30 grand every single year.
Every year. And it gets worse over time. The source actually is a staggering example of this compounding drag.
Let's hear it.
Let's say you have a $5 million portfolio, and it's earning an average of 6% annually. The difference between paying 0.75% in fees and paying 1.5% in fees.
Which doesn't sound like a big gap.
It really doesn't. But over 20 years, that difference amounts to over $1.2 million in lost wealth.
Wait, really? Over $1 million?
Over $1 million.
Just from a fraction of percentage point difference. That is insane.
Yes. And that is exactly why the stakes fundamentally shift for high net worth individuals. You absolutely need sophisticated fee reduction strategies because, like you said, the leak in the yacht is massive. Now, obviously, it doesn't mean you shouldn't pay for professional advice. It just means you have to understand exactly how that money is being extracted, and ensure the value you get back exceeds that cost by a wide margin.
Well, if we want to fix the leak, we first have to know where the water is flowing out.
Exactly.
So how exactly do these firms charge? Because I know it's not just like a one-size-fits-all model.
Oh, far from it. The guide outlines the 5 most common fee structures in the industry right now, and each carries completely different incentives.
Okay, let's unpack those. What's the first one?
The first, and by far the most common, is the AUM fee, or Assets Under Management.
Right, I've heard of that.
Yeah, this is where they charge an annual percentage of the total portfolio value they manage for you. It typically ranges from, say, 0.5% to 1.5% annually.
And importantly, the guide points out that this is usually tiered, right? Like the percentage should decrease as your assets grow.
Yeah, usually. So you might pay 1% on the first million, but maybe 0.75 on the next 2 million.
Got it. So if you're using an AUM model, you should always ask your advisor for the blended rate.
Yes, the blended rate. That's the actual average percentage you're paying across all those tiers, not just, the headline rate they advertise on their brochure.
Okay, but what if someone has a massive amount of wealth, but a lot of it is tied up in a business or in real estate?
That's a great question.
Because paying a percentage of just their liquid portfolio might not actually make sense for the kind of advice they need.
Right, and that is exactly why the second structure is growing in popularity, especially for high net worth clients, the flat fee or retainer model.
Okay, how much does that usually run?
This typically ranges from $5,000 to $50,000 or more per year. And it's highly favored by business owners or families with complex trust structures because it entirely removes the advisor's incentive to just, hoard your assets.
Right, because if I'm paying an AUM fee and I tell my advisor, hey, I want to pull $1 million out of the stock market to go buy a commercial property.
Their paycheck takes a massive hit.
Exactly. There's a built-in conflict of interest there.
Huge conflict. But a flat retainer removes that tension completely. They get paid the same whether your money is in the stock market or deployed into real estate, which allows them to give truly objective advice.
That makes total sense. But what if I don't need continuous year-round management? What if I just need someone to look at a specific tax issue?
Then you look at the third structure, which is hourly fees. This is usually $200 to $500 an hour.
Okay, pretty straightforward.
Yeah. It's rare for ongoing wealth management, but it's perfect for a one-off project, like if you need a second opinion on a specific tax strategy.
Okay, so those first three seem logical. But the guide raises a pretty major warning flag about the fourth structure, right? Commission-based fees.
Yes. This is where a broker or an insurance agent gets paid a commission on the specific products they sell you.
And the danger here is that you might not even see a direct fee on your monthly statement.
Exactly, because the cost is embedded in the product itself. For example, mutual funds with front-end loads.
Okay, let's clarify that for the listener. What is a front-end load, practically speaking?
It's essentially a sales charge you pay the moment you buy the fund. So say you invest $100,000 and the fund has a 5% front-end load.
Ouch.
Yeah, only $95,000 actually gets invested in the market. That other $5,000 goes straight into the broker's pocket on day one. You start in a 5% hole before the market even opens.
That's wild. Let me try an analogy here just to see if I'm tracking the incentives properly.
Go for it.
Let's compare these fee structures to getting a personal trainer at a gym. The AUM model is like paying a percentage of your total body weight every month. The more of you there is, the more you pay.
Ah, right.
The hourly model is like paying a trainer per session. You only pay when you explicitly ask for their time.
Yep.
But the commission model, that's like a personal trainer who tells you they'll train you for free, but they are secretly getting a massive cut from the gym every time you buy their specific brand of protein powder.
That perfectly illustrates the conflict. That trainer is heavily incentivized to push the protein powder that pays them the most, not the one that actually helps you build muscle.
Exactly.
Which brings us to the final and really the most crucial distinction in the industry, which is fee-based versus fee-only.
Right. So fee-only means the advisor is compensated exclusively by client fees. Literally no commissions at all.
None.
But fee-based means they charge fees, but they may also earn commissions on certain specific products, like, say, insurance policies.
Yes. And it's worth noting here that the source for our deep dive today, Davies Wealth Management, operates as a fee-based fiduciary, RIA.
Now, why is the word fiduciary so important there? I hear that thrown around a lot.
It's critical. As a registered investment advisor, or RIA, a fiduciary is legally required to act in your best financial interest at all times.
Meaning they can't just push the expensive protein powder.
Exactly. Commission-based brokers who aren't fiduciaries, they simply are not held to that same strict legal standard. They only have to ensure an investment is quote-unquote suitable, which is a much, much lower bar.
Okay, so even if I know which of these models my advisor uses, I'm guessing that's not the end of the story.
Not at all.
Because the guide mentions that the advisory fee is rarely the only fee you're paying.
Right, it's just the top layer of the onion. The guide points out that the average AUM fee for a portfolio between $1 and $5 million is about 0.85 to 1.10%.
But you have to peel that onion to see the total cost stack.
You do. You really have to look at the full stack.
So what else is hiding in that stack? What are we missing?
Well, beyond the advisory fee, you have fund expense ratios. Those are the internal costs of running the actual mutual funds or ETFs you're invested in.
And how much can those add?
They can add anywhere from a negligible 0.03% to well over 1%.
Yeah, okay.
Then you have custodial fees, which are charged by the actual bank holding your money. You have transaction costs for trading. And sometimes you have wrap fees.
Wrap fees, what is that?
A wrap fee is a bundled fee. It covers the investment advice, the trading costs, and the administrative fees all under one umbrella percentage.
That sounds convenient, honestly.
It sounds convenient, sure, but it can sometimes mask what you're actually paying for each individual service.
So if I'm not paying attention to the full stack, I could just be completely bleeding money without knowing it.
Oh, absolutely. The source provides a really stark contrast to illustrate this. Let's look at a $5 million portfolio.
Okay.
In a low-cost model, where the total all-in stack is 0.65%, you're paying $32,500 a year.
Got it.
But in a high-cost model, where the total stack hits 1.75%, you are paying $87,500 a year for the exact same $5 million portfolio.
That is a $55,000 difference every single year.
Every single year.
Okay, let me make sure I'm getting the implications of this.
Right.
Let's say I'm a tough negotiator, right? And I managed to grind my wealth manager down to a dirt cheap 0.5% advisory fee.
Okay, good job.
But then that manager turns around and puts all my money into highly expensive, actively managed mutual funds with huge internal expense ratios. Am I actually losing that negotiation?
Oh, absolutely. You could easily end up paying more total drag than your neighbor.
Really?
Yeah. Say your manager charges 0.5%, but puts you in funds charging 1% internally. Your total stack is 1.5.
Right.
Meanwhile, your neighbor pays a premium advisor a flat 1%, but that advisor only uses ultra-low-cost index funds charging virtually nothing.
Ah, I see.
Yeah, your neighbor is paying less total money out of pocket, despite paying a higher upfront fee for the human advice.
Wow. So if I'm looking at my statement and realizing I'm actually paying 60 or 80 grand a year across this whole stack,
Yeah.
my immediate thought is, what on earth am I getting for the price of a luxury car every single year?
And that is the right question to ask. This is where we separate a mass market broker from a true high net worth wealth manager.
How so?
Well, a standard broker at a national firm is essentially trained to sell packaged investment products to a broad base of people. But a wealth manager for high net worth clients is expected to coordinate incredibly complex financial engineering.
The guide mentions this shift in service really starts to matter at the $500,000 to $1 million mark, right?
Right, and it becomes absolutely critical once you surpass $3 million.
It sounds like the difference between a mechanic who changes your oil and rotates your tires once a year versus a Formula One pit crew.
That's a great analogy.
Because the mechanic is just doing routine maintenance. But an F1 crew is making real-time aerodynamic adjustments while the car is moving at 200 miles an hour, just to shave seconds off your lap time.
That's exactly how you should look at it. Let's look at the core services that any advisor should be providing, the oil changes, basically.
Okay, what are the oil changes?
This includes tax loss harvesting, which means proactively selling investments at a loss to offset your capital gains. It includes retirement income planning, managing required minimum distributions, optimizing when to take Social Security.
But the F1 pit crew stuff is what the guide calls advanced services, right? For portfolios over $3 million.
Exactly. This is the stuff that actually justifies the fee.
The guide mentions something called IRMA planning. What is IRMA and how does a wealth manager mitigate it?
So IRMAA stands for Income-Related Monthly Adjustment Amount.
Okay.
It's essentially a hidden cliff tax for retirees. If your modified adjusted gross income, which we call MAGI, goes even $1 over certain thresholds, Medicare slaps you with a massive surcharge on your premiums.
Just $1 over.
Just $1.
And what exactly goes into that MGI calculation?
It's essentially your total income plus certain tax-exempt interest you might be earning, like from municipal bonds. If you aren't paying attention, a sudden spike in income, maybe from selling a property or taking a large required distribution from an IRA, pushes your MGI right over the cliff.
Wow.
And by 2026, those surcharges can exceed $5,000 per person annually.
Wait, That's $10,000 a year for a married couple just completely vanishing.
Just because they went $1 over the limit.
That is brutal.
It is. So an advanced wealth manager will proactively engineer your income. They will time capital gains or utilize specific deductions to keep your MGI just under those thresholds, completely avoiding that $10,000 trap.
Incredible. The guide also highlights Roth conversion ladders. Mechanically, how does a ladder actually save you money if you still have to pay taxes on the conversion?
It's all about tax bracket arbitrage.
Okay, break that down for me.
So you have a traditional pre-tax IRA. Eventually, the government is going to force you to take money out and pay taxes on it, often when you're older and potentially in a higher tax bracket because of those forced distributions.
Right.
A Roth conversion ladder involves systematically moving chunks of that money into a Roth IRA during years when your income and therefore your tax bracket is lower.
Okay, so you're timing the tax hit.
Exactly. Think of it like transferring grain from a taxable silo into a tax-free silo, but only doing it in the years when the tax collector is charging his absolute lowest rates.
That's smart.
You voluntarily pay a small tax now so that the money grows completely tax-free forever. It totally removes the ticking time bomb of future required minimum distributions.
What about executives who have a massive portion of their net worth tied up in their company's stock? The guide mentions using exchange funds, and I have to admit I'm not familiar with that tool.
Oh, exchange funds are brilliant.
How does it diversify someone without triggering a massive capital gains tax bill?
Okay, imagine a potluck dinner. You are a tech executive, and you show up with a giant bowl of Apple stock.
All right, I brought the Apple stock.
Another executive shows up with a giant bowl of pharmaceutical stock. Another brings banking stock. An exchange fund allows all of you to pool your highly concentrated single stocks into one giant basket.
Okay.
In return, you get a proportional slice of the entire diversified basket. Because you technically didn't sell your stock, you just contributed it to a partnership. You don't trigger any immediate capital gains taxes, but you instantly achieve diversification.
That is incredible. I had no idea you could do that.
Most people don't.
And then the guide gets into multi-generational planning, mentioning dynasty trusts and charitable remainder trusts, or CRTs.
Right. A dynasty trust is a legal structure designed to pass wealth from generation to generation without incurring transfer taxes like estate or gift taxes every time the money changes hands.
Oh, wow.
It essentially walls off the wealth from the IRS for your children, your grandchildren, and beyond.
And a charitable remainder trust. How does that one work?
A CRT is a fascinating mechanism. You transfer a highly appreciated asset, like real estate or stock, into the trust. You get a massive upfront tax deduction for doing so.
Right, yeah.
Then the trust pays you an income stream for the rest of your life. When you pass away, whatever is remaining in the trust goes to a charity of your choice.
So it's a win-win-win.
Exactly. It's a way to generate lifetime income, reduce your current taxes, and fulfill your philanthropic goals all at once.
Okay, when you lay out the mechanics of IRMA mitigation, Roth ladders, exchange funds, and dynasty trusts,
Yeah.
I mean, I can see how this F1 pit crew easily pays for itself.
Oh, without a doubt.
In fact, the guide cites research from Vanguard called Advisors Alpha, which estimates that a highly skilled advisor utilizing these strategies can add approximately 3% in net returns annually.
3%. And they do it not by magically picking better stocks, but through hyper-efficient tax engineering, estate planning, and behavioral coaching, to stop you from panic selling during a market crash.
Right.
That 3% return on value easily covers a 1% advisory fee.
So we know what good value looks like now. But what are the red flags?
A major warning sign is paying a premium fee, say, over 1.25% on a portfolio above $5 million, but receiving zero comprehensive planning.
Just paying for the privilege of them holding it.
Yes. If your advisor is just holding your money in mutual funds and sending you a quarterly performance report, you are vastly overpaying.
What about the opposite end of the spectrum? Fees that look suspiciously low.
Robo-advisors are a perfect example of this. They might charge a rock-bottom 0.25%. But they offer zero tax strategy, no IRMA planning, no trust coordination, and absolutely zero human relationship.
Right, you're on your own.
For a complex high net worth situation, an algorithm is completely insufficient. And another red flag is anyone advertising no advisory fee setups.
Because there's no such thing as a free lunch.
Exactly. Almost always, that masks massive hidden commissions being taken on the back end through front-end loads or expensive insurance products.
Now, I'm assuming the wealth management playbook looks fundamentally different depending on where you actually live, right?
Oh, very much so. Geography plays a huge role.
Since this guide is produced by Davies Wealth Management out of Stuart, Florida, they focus heavily on local nuances. And obviously, Florida has no state income tax.
Which is a massive tailwind. It makes those Roth conversions we just talked about incredibly attractive for Florida residents because you are only paying the federal tax rates to do the conversion.
The guide also brings up Florida's unlimited homestead exemption.
Yes, that's a big one.
Basically, if you are sued or file for bankruptcy, your primary residence is protected from creditors, no matter how much it's worth. But it also warns about the complexities of establishing legal domicile, especially if you're moving from a high-tax state.
Yes, the dreaded domicile audit.
What is that?
If you move from New York or California to Florida, your old state does not want to lose your tax revenue.
Obviously not.
They will audit you to prove you never really left. They will check where your primary doctors are, where your dog is registered, where your country club memberships are.
They track your dog. That's intense.
They look at everything. A local Florida wealth manager knows exactly how to bulletproof that transition so you don't get hit with a surprise tax bill from a state you don't even live in anymore.
Now, here's one local nuance that genuinely surprised me. The guide stresses that a Florida wealth manager needs to coordinate specific hurricane and property insurance risk management.
Yes.
But why does my wealth manager care about my hurricane insurance? Isn't that just a job for my property insurance agent?
Well, an insurance agent's job is to sell you a property policy, but a true wealth manager is looking at your entire balance sheet.
Okay, how so?
Let's say a catastrophic hurricane hits the Treasure Coast and causes hundreds of thousands of dollars in property damage, and your insurance disputes or delays paying the claim.
Which happens all the time.
Exactly. How does that impact your immediate liquidity? Are you going to be forced to sell off your stock portfolio during a market downturn just to pay contractors?
Oh, I see.
Or do you have enough umbrella liability coverage if a roofing contractor is severely injured on your damaged property? The wealth manager ensures your insurance limits perfectly integrate with your investment portfolio, so one physical disaster doesn't trigger a cascading financial collapse.
It really is about seeing the whole board, not just the individual pieces.
Exactly.
So, bringing all these mechanics, hidden fees, and local strategies together, what is the practical checklist for you, the listener, the next time you sit down with a financial professional?
The source gives us 4 vital questions you absolutely must ask to uncover the truth about your fees. Number 1, are you a fiduciary at all times? Not just part-time when you're giving advice, but always.
Okay, always a fiduciary. Got it.
Number 2, what is the total all-in cost?
Meaning the whole onion, right? Including those fund expenses and wrap fees, not just the top-layer advisory fee.
Exactly. Don't let them hide the rest of the stack. Number 3, how are you compensated if you recommend an insurance product or an annuity? You want to uncover any hidden commissions.
Because of the protein powder problem.
Exactly. And number 4, what custodian holds my assets? You always want your money held by an independent third-party institution like Charles Schwab or Fidelity, not by the advisor's own firm.
That makes total sense for security.
It's crucial.
Well, I want to leave everyone with a final, slightly provocative thought to mull over. We've talked a lot about the mechanics of wealth building today and the true value of advice.
We have.
If you review your current financial relationship and you realize that your advisor's only real value proposition is, quote-unquote, picking investments for you, are you fundamentally overpaying for a service that a software algorithm could realistically do for a fraction of the cost?
It's a vital question. You really shouldn't be paying premium F1 pit crew fees just to have someone sit in the passenger seat and watch the speedometer.
Right. Think back to that multi-million-dollar yacht crossing the ocean. It's not enough to just hire a captain who knows how to steer the wheel. You need a captain who knows exactly how to find those tiny structural leaks hidden deep in the hull.
The taxes, the hidden fees, the inefficiencies.
Exactly. You need someone who can patch them long before they can sink your voyage. Because when you are navigating wealth at that scale, those little leaks aren't just drops in the bucket. They are the difference between washing up on shore and actually arriving safely at your destination.